Hey, this is Geoff Gannon, and you're listening to the Focus Compounding Podcast. This is the podcast where Andrew and I talk general investing concepts. If you want to know more about specific stocks I like, go to focuscompounding.com, where you can read stock ideas written up by me and other members. Membership costs $60 a month, but if you use the promo code podcast, it'll be $50 a month for you. Andrew and I also manage accounts for investors. To learn more about our managed accounts, email Andrew at info@focuscompounding.com. or text or call Andrew at 469-207-5844. That's 469-207-5844. And now here's Andrew with your regularly scheduled podcast.
Welcome. How is everybody doing out there today? Hope you are doing well. My name is Andrew Kuhn with the Focus Compounding Podcast. Mr. Geoffrey Gannon, how's it going over there?
It's going very well, Andrew. How's it doing with you?
Going great. Cut you off. It's like I know what you're going to say because
Yep.
I say that we say the same thing every single time. Hope it's going well for everybody else as well. Thank you so much for tuning in with us here today. We are going to be doing a rapid fire questions.
Okay.
All right. So this is part one. So that means that there's going to be another part. And
right.
A lot of people have sent in questions on Twitter. And if you do want to ask questions in the future, you could DM me, tweet at me. I usually save them. And then every now and then I'll do like a call for questions, and you can send them to me and we'll talk about it on the show.
That's at Focus Compound.
At Focused Compound. Also, if you do want to get access to our investing idea website where Geoff writes a lot of ideas, go to focuscompounding.com and use the podcast promo code. And what that'll do is it will take $10 off of the price indefinitely as long as you do stay a member.
Right. The code's podcast.
Spell it for them. I'm just kidding. Alrighty, cool. So, rapid fire, right? So we're going to try to see how long. I don't know how many questions. We have no agenda. We'll see how many questions we get through for 25 to 30 minutes and kind of go from there. Alrighty. So this guy asked, or gal, what is Geoff's opinion on insider ownership and insider buying and selling in a stock? Can there be other reasons for insider buying other than the insiders think the stock is undervalued?
Yes, there could be other reasons, but generally, I agree with Peter Lynch, who said there's a lot of reasons why someone might sell a stock, but there aren't a lot of reasons why they might buy a stock. You're not generally going to buy a stock that you think is overvalued. So insider buying is always a good sign, I'd say. Mm-hmm. Insider ownership is a little more complicated because it means that someone might have more control of the company, things like that. There's certain companies that I look at, especially very small companies. I was looking at one just recently, which is on my watch list. And two insiders, I think, own close to 40% of the company combined. That presents a problem if they're in management positions, things like that, and they don't, say, want to sell off the company, don't want to borrow money, pay out dividends, do things that might get you better returns. So it's a protection against activism.
Sure.
So sometimes protection against activism is fine. If you have big insider ownership at Berkshire Hathaway, you probably like the way that Buffett runs the company, and then it's great. But if you have big insider ownership at a company that's not run very well, or that is run for reasons that aren't just to maximize returns, then it could be a problem. But insider buying is always a good sign.
Sure. Yeah. I'll take a step further. Do you ever factor in institutional ownership and like that?
Yeah, I don't want to see it.
Really?
Yeah. Institutional ownership is a thing that you most don't want to see.
And why is that?
Because institutional ownership basically means that the stock is more likely to be efficiently priced. Mm-hmm. So the thing that...
I guess it doesn't move around as much.
Yeah, well, sometimes they move around a lot, but I guess they move around pretty randomly around sort of a valuation that makes a lot of sense. I mean, in panics and things, institutions sell pretty quickly and stuff like that. And sometimes I think faster than individuals. Certainly in like 2008 and stuff, I saw that stocks, big stocks that were owned by hedge funds and things, declined a lot more rapidly than stocks that were owned by individuals who seemed more level-headed about that stuff. But in general, they've done more research and things, institutions. Individuals might be more likely to hold it for a long time, I think, depending on the stock. So there's lots of little microcaps and things where I think that having very, very low institutional ownership is good. Mm-hmm. So yeah, I mean, I think that having a lot of insider buying is a great sign. And buying from individual investors, yourself, when you go out and buy the stock, is usually more likely that you'll get a good bargain than buying from some hedge fund or some mutual fund or something. Yeah.
Sure. Cool. Next question. Do you and Geoff listen to other podcasts? Except from your own, what are your favorite podcasts at the moment?
Wow, that's a very good question. I do listen to other podcasts, not investing related usually. I have in the past listened to several investing podcasts, some of which don't podcast regularly, so I don't want to name them and say they should come out with more regular podcasting. But yeah, in the past I've listened to lots of investing ones, basically ones that talk about specific stocks.
Sure.
That's the thing, yeah.
I would say mine probably Patrick O'Shaughnessy.
Okay.
He covers a bunch of different topics, and he gets on a lot of interesting people.
Yeah, that's a really good interview show.
Yeah, for sure. Which podcasts do you listen to outside of investing? Or I mean, you said that
movies, comedy shows, movie review shows, comedy shows, things like that. Yeah.
Perfect. And then I also listen to Joe Rogan podcast because that's funny.
Is that how you learn about Elon Musk?
Yes, yeah. That's how you learn about Elon Musk. Okay. What do you consider the most important stock metrics to analyze when you try to identify a quality company with a moat, like high and stable ROTC, I'm guessing return on tangible capital, stability in margins, positive and increasing free cash flow, high free cash flow to sales, positive growth, ? So what do you consider the most important stock metric to analyze when you're trying to identify a quality company with a moat?
Okay, so if you could only have one metric, the one you would want is actually probably the variation in EBIT divided by sales. So operating margin divided by sales, but the variation, not the number. Mm-hmm. So in other words, seeing that a company has a 20% operating margin, but that it varies to be in some years 19, some years 21, but it's never 10 or something like that. And you can measure that using standard deviation over a long period of time. Examples of really low ones that you can look for the kind of stability I'm talking about would be like Omnicom, which is an advertising agency, Costco retailer. Mm-hmm. They have unusually low variation to the point that if you look at, a good thing to look at is ask, well, what would 4 standard deviations look like? The way that like a normal distribution works, it would be, in theory, incredibly unlikely that you would ever see a 4 standard deviation move in something. And in fact, in some of these, that's true. Like I believe with Omnicom, last I looked at it, in the 30 years or something, it had never even had a 3 standard deviation move. Mm-hmm. So so say the standard deviation is 1.2% of the margin or something. The biggest change that you see is like 3.5% or something. So it's not even 3 times the standard deviation. It's just an indication that it's unlikely to lose money in any year. But more than that, it's something about basically pricing power. Mm-hmm. So Costco is like the reverse, right? It's not that Costco has the ability to charge high prices, but it has the ability to get very low costs, right? And so it gives an indication that it's a low-cost company there. Or with Omnicom, you're getting the impression probably that there isn't a lot of pushback from clients on exactly what the price is. So the same thing you should see with like a money manager or something, right? That they're not negotiating each case. Okay, we charge 2% of assets in this case, but we're going to charge 1.9 in this one. We're going to, and they want to break on things, you know. So it's the ability to, in recessions and things like that, put the not act as a shock absorber. Other people, your suppliers, your customers, suffer more than you do. Your competitors. But you seem to be more stable in the overall economy. Mm-hmm. And that's a really good indication that you have a strong market position, that you basically have the leading position. If you think of it like a horse race or something, you have the inside pole position. You're in that one slot, and there are others that are 6, 7, 8. They're the more marginal ones, and they'll see much more margin variation. Mm-hmm. So Costco, compare that to other retailers, almost all of the retailers have more variation in their margin than Costco does. Things like that. So you want to find the companies that are the least marginal, the ones that have the least amount of wobble in their earnings relative to sales.
Yeah, and I will also add that every single company we look at, we go back and look at the EBIT and mm-hmm. that variation as far back as it could go.
Yeah, right.
That's one of the things that we do.
Mm-hmm. And of course, in the long run, what matters is the return on capital. Uh-huh. But for a lot of companies, the ratio of assets, of sales to assets, the turns, is just not going to vary as much. So the number that's easiest to look at is the EBIT margin, the relationship between EBIT and sales. Mm-hmm. But it's the variation and that matters most. There are stable companies with 2% operating margins and with 20%. It's just a question of how much they move relative to their margin.
Yeah, because some people could look at a company and be like, oh, that's a low margin business, and think maybe I don't want to go there, but that could just be their business model.
Right. Costco's super low
same
margin,
way.
but
Yeah.
has very stable margins. Yeah.
Cool. For a concentrated value portfolio, what do you think of the idea of having a rule of not selling a stock you have bought before 3 years have passed? You think it will increase the quality of decisions and returns for most investors?
So I will do it this way. If you can tweak that a little bit, yes. So if you can sell in the first 3 months, but not the 3 years after that, then yes. It often happens that when you start to buy a stock or get really serious about you're about to buy a stock, you start to think a little bit harder about that. I was just listening to an interview with Warren Buffett, and he talked about how Oracle appeared in his stock holdings for like a quarter, and then it disappeared. And they asked him about why was that? Were you the one who bought it and everything? And he said, yeah, I was the one who bought it. And I thought the same things about how good it was and reasonably priced and whatever. But I realized as I bought it and owned it, I didn't understand it as well as I thought I did. And so I sold it. And I would say that sales that are made like immediately after you buy a stock, in my experience, are good sales.
Because of what you realize that you don't understand it.
Like as soon as you own it, you decide in the first few months, oh, I want to sell this. So you know, selling a stock within the first quarter or something after you buy it makes a lot of sense. But after that, holding it for 3 years, yeah, I think that if you're right about the stock, waiting 3 years will probably be pretty good returns that way. Yeah, it would make a lot of sense, and people would be better off that way. And also, on the other hand, not owning it that long after 3 years. Although I talk a lot about owning things long term, there's plenty of research that shows that if you're right about the value stuff, selling 3 years after buying a stock makes a lot more sense than owning it for 10 years or something.
A lot of people, especially me talking to like prospective investors and stuff, they talk about like how long do we hold a stock for?
Right.
And I think because we talk about when we value, we think about what a private buyer would pay for that business in 5 years.
Right.
A lot of people probably assume or get the impression that we hold for 5 years, and that's just not always the case.
That's not the case at all.
Yeah.
So I mean, it depends. We'll hold a stock for 5 years if the stock goes nowhere. You know, if the price stays the same. But if you have a price that triples or something, then yeah, you would probably sell it.
Cool. Next question. What does Geoff mean when he says he's not interested on following stocks he already owns? ? Does that mean that he will not read quarterly reports or earnings and transcripts rather than do an annual review of the stocks he already owns? Have you ever said that?
I have said that, and that is true. Compared to most people, I spend much less time looking at the stocks that I already own. I do read the transcripts if they exist. We own a lot of stocks where there aren't transcripts, to be honest. I own a lot of stocks that are overlooked stocks, and so not that many of them have transcripts, but some do. I can think of one. And I do read that. I read everything they put out quarterly. What I don't pay a lot of attention to is what the movements in the stock price during the quarter. And it is true that I think my time is better spent learning about a new stock that I might buy than doing a lot of research for a stock that I already own. The reason for that is it's incredibly rare that something I learn about a stock in a quarter is going to fundamentally change my opinion of the stock. And that's what I was just talking about with like Buffett and Oracle. In those when you're first analyzing a stock, let's say I want to own NACO or something, and I've analyzed it for a while, and then I decide I want to buy it, and I buy it, and then I own it for 3 months. A lot of what I know about that stock happened in the research process and also in the owning it and trying to understand it and be comfortable with it even while I own it in the first few months. But the idea that a year or two down the road I have a really different opinion because of some results they stated just isn't true. And so like I've talked to lots of people that way where I wrote about bank stocks and things in the past, owned Frost. And people would talk every quarter about their results. That's the question of, did the Fed raise rates? What was the exact timing on that? The repricing of loans. There's so much noise in individual quarterly results that it's really tough for people to analyze that. I mean, we own a stock, for instance, that like if one big customer leaves them because they get acquired or something, that would fundamentally change their results for a quarter. It wouldn't show up much in like the yearly results. So I do like to spend a lot more time, and I think most people should spend a lot more time trying to research a new stock than spending a lot of time worrying about the stocks they already own. I think a lot of it is worrying about it. You know, you feel like you should spend a lot of time thinking about it, but you're trying to do all the due diligence before you bought it.
Yeah.
Now, if something looks different from one of the key things that you decided on was right about the stock in the beginning, then you should really reconsider and maybe sell it. I have said before, one of the things I do is I rank all the stocks. So it's very important that people remember that if I own 5 stocks, I'm ranking which I like best, which I like least all the time. I'm keeping that in an Excel file.
Yeah.
And so because I do that, I'm not spending much time thinking about my favorite stock at all. I'm only really thinking about the number 5 or number 4 stock, because I wouldn't sell the stock I'm most comfortable with.
Yeah.
And I think a lot of people, if their biggest position in their portfolio, they think about it a lot. But to me, I don't think you should think about your biggest position in the portfolio that much,
Because it's probably the safest, right?
It shouldn't be
In
the
theory.
biggest if it's not.
Yeah.
Right. If you think you need to think about it a lot, don't make it the biggest position in your portfolio.
It's kind of like the Greenblatt thing when he says like his biggest positions aren't the ones that he thinks he's going to make the most amount of money on. It's the ones that he feels he's not going to lose any money on.
Right.
Back in the day, he said that. So probably the ones that he was most convicted on, but also that he thought was the safest.
Yeah. So at this point, I don't think Buffett should be thinking a lot about Apple and Coca-Cola.
Yeah.
But it's better to spend time thinking about Oracle, even if you decide that you're going to sell it or something. But in the very early stages, yeah. But he's probably obsessing about it at that stage, and that's what I'm doing when I'm looking at a stock. Before I buy it, it's taking up all my time thinking about it. Yeah.
Cool. Next question. The person asks if we have any recommendations on on companies with good written annual reports or 10Ks.
Oh, that's a good question. Yeah, so I think some companies have very good annual reports in 10Ks. I mentioned NACO, I think, for what the business is. It explains it very well, but it's very complicated.
I thought back in the day, Strayer University, they're I don't think they're public anymore, but I always enjoyed reading their 10Ks. And like their annual letter from the the chairman.
Yeah, I pointed out a while ago that I thought that Energizer Holdings had particularly good annual reports, especially because of how it presented some accounting things and things like that.
I'm thinking like a long-term investor.
Yeah.
Amazon is pretty good, I think. If you go back and read Jeff Bezos, all of his letters, they've always been pretty good. And I mean, I just love Amazon, so the annual report's fun to read too. Berkshire. Who else do people obsess over? Markel? Or
yeah,
you ever read that?
Sure. Yeah. There's a lot of annual letters that you could probably find where people talk about their favorite capital allocators and things like that. Yeah, I don't know. I mean, one of the things though is that you have to get really comfortable reading difficult reports, I guess, reports where they maybe don't put in a lot of work to help you understand it, because that's where you're going to find a lot of situations that are attractive. So it's fine to read those things, but I that is a question I get a lot from people, and in some ways, if their reports are really good, that means other people are likely to understand it well too.
Yeah.
So there is an element of having to get comfortable understanding businesses where that's not the case. For most people, I would say read investor presentations, especially to start with.
Yeah, and they add more clarity. For sure.
And especially anything that's planning a spin-off or has spun off, go back and read the thing that was its spin-off. You could read things that are IPO things. I never buy an IPO, but they'll give good explanations of things there. Spin-offs and IPOs especially, but also buyouts, acquisitions of things will give pretty good explanations. And you can kind of use that to help you understand situations on your own. But eventually, to make money, you're usually going to have to look at situations where the company isn't going out of its way to explain things to you, and you're going to have to kind of apply the lessons you learned from easier to understand reports.
Alrighty, next question. Is Geoff a full-time investor? How does a typical day look like for him?
This is interesting because I've gotten this question a lot of times.
Really?
I don't know why, but people are, in terms of emails that people say, yeah that's a lot. I'm a full-time investor and writer for the website. Yeah. We have a member website, and that is a significant part of what we do. Other than that, a typical day involves keeping track of certain lists, mainly the stocks that we already own and the stocks that I'm planning to look at. I have a research pipeline, which is what we put out as the watch list, and writing some things. Usually a write-up of a stock for the website. And then there's a lot of reading of 10Ks, investor reports, things like that, investor presentations. In terms of time, just reading 10Ks is probably the biggest time. I do collect some things from blogs and things like that from people. So I guess there is a part. I was going to say that reading 10Ks is the biggest part, but that might not be true. In terms of actual time spent, it's probably pretty evenly spent between writing, which includes responding to emails and things like that, and writing for the website, and client letter, memo, things like that.
Yeah.
And then, so that's close to a third of things. Then a third of actually researching stocks. And then there's probably a third, honestly, of generating new ideas. So that means going through other things that people have talked about. So a lot of blogs and things, finding names of stocks that I might be interested in, and especially overlooked stocks. That's the thing that we focus on. And so that's pretty bigger amount of time than people might think is finding those ideas, because people don't write about them as much. And like if you deal with big stocks, you don't have to spend that much time getting sort of casting the wide net to find just ideas you're interested in.
Yeah, sure.
But more time than people might think is spent gathering up just names of stocks and things of microcap stocks and things like that. Yeah.
So pretty much, yes, you're a full-time investor.
Yeah, and writer for the site too. Yeah.
Cool. This guy says, suggestions for stock screens to run on a screener to find quality companies that are worth reading their annual reports, ? What stock metrics, ? I think it's strange to read the annual report before looking at fundamental data, as I heard you did on the checklist episode.
Let's see. Screens are interesting. I do run some screens sometimes. I don't find them to be as useful as people might think. A very, very small number of ideas that I've had that turned out to be good ideas originated in any sort of screen. I would say a pretty wide screen is a good idea. I like, for UK stocks, there's Sherlock Holmes, which is good. You can see long-term financials there, like 10 or 12 years or something. I like that one, and you can create your own screens there. And I do, and would probably be things like EV to EBITDA is the most common one, but also price to book, which you could run separately. So look for things that are cheap on assets, look for things that are cheap on EV to EBITDA, and then you can do things using the F score, the Z score to sort of sort it out. Usually just EV to EBITDA and size is a big part of it. I'm looking for smaller stocks. If a stock is very cheap compared to price to book, or very cheap compared to EV or cheap enough compared to either EV to EBITDA or price to book, that's a good thing for a screen. That's not a reason to buy a stock, but anything below book value, you can read about, you can learn about it. Anything below, 10 times EBITDA, things that are 3-4 times book value or more than 10 times EBITDA, you're going to have a lot of expensive stocks on your list. And so you're going to have to do a lot of reading for that.
Sure.
Very little screening though.
Same person asks, I think I remember Geoff mentioning that he thinks investors should invest in stocks in their home countries rather than abroad. Is the reason for this is it's more likely to be within our circle of competence and the markets are more inefficient?
Yeah, you're more likely to have an informational advantage. Yeah. So like, say, Norway. I know some people from Norway. I've looked at plenty of stocks in Norway. There are cases where half of the stock is in the hands of foreigners, a lot of Americans and things like that. I've looked at tons of stocks even stocks that I've owned in Japan that are pretty small stocks are owned by some other Americans. Americans go all over the world buying stocks. So that's the advantage that you have. The biggest disadvantage that I have as being someone who knows the most about the United States is how thoroughly looked over that market is, both by institutions and individuals in the U.S., and also so many people outside the U.S. look into the U.S. to find ideas. So yeah, look in your home state, look in your home country. Absolutely. I say that all the time to people in the U.S. If you live in Minnesota or something, look for every public company that's listed in Minnesota. There's a chance you might know more about it and things like that. Sure. Several of the stocks that I had that as a teenager I invested in and had good results with were headquartered in New Jersey. It's possible to learn more about those companies sometimes than other people know. As an example, I invested in Village Supermarket, and we had an interview where we talked to someone about Village Supermarket.
And you were an employee there.
Yeah, and the truth is, I remember reading online about some people shorting the stock and things like that. And in two different cases, I read about people shorting the stock, and it wasn't a heavily shorted stock or anything, but it was clear from reading about it they had never been in a ShopRite. So that's a regional supermarket in New Jersey, in New Jersey, Pennsylvania, and New York area. And it is something that someone from Texas who might know more about HEB or something, or someone from Florida who might know about Publix or things like that, would not know about. And so they're at a disadvantage. Or for instance, Kroger, like they'll say, you'd read about something, they'd say, Walmart and Kroger are going to come in and take their business.
Yeah.
Well, there's no Kroger in the state. Walmart, that's a very weak region of the country for Walmart, right?
Sure.
So, but if you're living in Oklahoma or something, well, Walmart is incredibly strong there. So you have just a different view of the entire world that way. And there are differences in the way that, Hong Kong works from the way that major cities in the U.S. work, and you would know that, and I wouldn't know that. Yeah, so you're at an advantage.
You understand the law, too, and just there's a lot of, I completely agree. And it's kind of like we talked about Green Brick Partners and how we're in the Dallas market and how they're headquartered here, and a lot of their businesses in DFW area as well. So we could see it with our own eyes. I mean, I pass their stuff every single day. Yeah,
and that's also something that Peter Lynch talked about, buy what you know.
Yeah.
But people often talk about that as if it's much simpler than what he was saying. But what he was really saying in his book was that he would talk to people who are in the drug business, right? And they would want to talk to him about oil stocks. They don't know anything about oil stocks. Yeah. They do know something about how the drug business works. So it's always good to pick industries that you know about that way. And then it's also good to talk to people who are in those industries and things. And that's something that I've done as much as possible with those singular diligence reports and things. I talked about that I researched John Wiley, that I own Barnes & Noble, things like that. Well, I talked to people that I knew who were in publishing and things like that for years to try to understand things better, including understand the personalities involved better. I mean, that's one thing. If you live in Norway, or you live in Hong Kong, or you live in wherever, especially if it's a smaller place, you might know more about the people who are some of the biggest investors and run some of the biggest companies and things in a way that much of the rest of the world doesn't know about them. And especially things when it comes to fraud and stuff like that, you're at a huge advantage. And political things of understanding how much certain things might be based on political connections or whatever versus people in other parts of the world. I read a lot about people in the U.S. or something talking about investing in Eastern Europe or something. Well, what do they know about how people in those countries got that wealth and how much they depend on certain political situations or whatever staying the same, especially when you're talking about banks or utilities or things like that. So you're at such a big advantage potentially. You want to look for any situation where you might have a informational advantage versus the people you're buying and selling the stock with. So I talked before about seek out stocks where you're buying from individuals instead of institutions who have people on the payroll researching these things.
Yeah.
Same thing. Look for things you're really familiar with that maybe there's some other people buying and selling that don't know it that well.
Cool. And then we're going to do the last question because, like I said, this is a 2-part series.
Okay.
I think it's a good one to stop with. He says, do you think investors should specialize in stock picking strategies, for example, like net stocks, or have a more general approach, aka looking for value in different types of stocks?
Specialize.
Yeah. That's something we've talked about, I think, a lot on the show.
Yeah. I mean, anytime that something is so obvious from a common sense perspective that you should buy it, absolutely do it. There shouldn't be a rule that you think of yourself as only a value investor, growth investor, that you rule out something else. Absolutely not. But you should specialize as much as possible. And it's not a bad idea to have a couple specialties, which is what you can do. So you can, when we talk about diversification and things like that, okay, well, if you can be really good at understanding nets, but if you can also be really good at understanding, higher growth companies or whatever, higher quality companies, well, part of your portfolio can be focused on nets and another part can be focused on those sorts of things. I think the greatest danger is taking a little bit of everything and thinking that what you're doing. So, buying sort of the, growth at a reasonable price or something that the crowd would think is a pretty good idea,
Mm-hmm.
but which you may not have really thought about that kind of concept carefully, right? So I think that something like net nets or something is a good idea, and especially if you're in a country where there are net nets, or focusing on looking into that country. I mean, yeah, it's something that like I would look in Japan for net nets, because it's something that I've done before, and it's something I'd be willing to do again. So I'd look at microcap stocks, spinoffs. Everyone can start working on spinoffs. That's a category that's always there. Something like net nets, there really are no net nets in the U.S. a lot.
Mm-hmm.
And in a lot of countries, there are no net nets. So net nets are great, but they're very hard to find. And you know, the thing with that is if you don't do that, then someone who comes in and tries to buy one net is very likely to buy a fraud or something because they haven't spent time looking at those, just seeing what's out there. Yeah. Whereas you, by someone who focuses on net nets, would see very quickly that you get more accustomed to the fact that a lot of these are frauds or something like that.
Mm-hmm.
Whereas people coming from big stocks don't think that way.
Now, what about specializing in a certain industry? Like our friend Nate Tobick, he specializes in oddball stocks. He specializes in bank stocks, right?
Banks are one of the best. Yeah.
Or being a pharmaceutical investor or an oil investor. Do you have any thoughts on that?
Yeah, I think it's a good idea.
Because you just understand it in and out, who the hot shots are or not, and just kind of understand the full
and I'll
industry.
tell you right now, in terms of, especially for U.S. investors, but for anyone, but especially U.S. because the way it works, if you can learn to become really good on banks and insurers, I mean, that could just be, you don't need to know anything else.
Yeah, and I think the answer, I'm guessing, is what you're getting to is what? Because there's so many publicly traded banks out there. There's so many, and small too, that are just pretty esoteric and don't get followed by a lot of people.
And a lot of big investors don't try to carefully understand the differences between the banks. They just go, I want to allocate a bunch of money to banks, and they buy them. I see that a lot where like they buy a bunch of different regional banks instead of trying to pick out what exactly is the regional bank I want to own.
Mm-hmm.
Do you want to own Frost? Do you want to own Bank of Hawaii? Do you want to own BOK Financial, things like that. I mean, those are things that we wrote reports on that are kind of similar banks. I mean, Prosperity Bank in Texas is another one. So there's like 4 that I've named that are all kind of the similar size and things that people would group together completely. But you can research them and decide which one you like best, And a lot of big investors don't do that. And the very long-term record can be pretty different for a bank and for an insurer. And those are the 2 that I would say, if you want to like get an industry specialty that you really, really understand, the best one is banks and insurers. Mm-hmm. There are other things like restaurants and retailers and stuff that there's always a supply of, but there's often fewer small ones and fewer sort of localized ones. They go national much quicker.
Yeah.
So it's harder. That used to be a good thing to do, and if you read like some of the old Peter Lynch stuff, he talks about that, but they've gotten to be where they raise funds and go national so quickly that I don't think that's the same situation. But I think banks and insurers often are not all across the country and aren't that well known.
They get little one-off companies.
Yeah. So those are the 2 industries I'd say if you're going to specialize: banks and insurers.
Cool. I think that is awesome. I want to thank everybody for sending in those questions. Again, if you do want to have your question asked or answered on the show, you could always DM me at Focused Compound on Twitter, or just tweet it at me. And oftentimes I'll just take a screenshot of it, and then Geoff and I do these Q&As, I don't know, probably once a month, and we'll just, we'll talk about it on the show. We want to get through all of them. Anything else to add that I forgot for the show?
Nope, that's it.
That is it. And if you do want to get access to Geoff's weekly memos, sign up at Focus Compounding. There is a free part of the website now. It has some content on there written by other investors, and then you'll also get a free memo.
And the memo will have links to whatever free content there is.
Exactly.
So you basically just sign up, and then whatever free content there is, it'll be in that email. You'll have links to whatever. So you don't have to go around looking for it. It'll always be the memo.
That is correct. I want to thank everybody for tuning with us here today. Have a great week. We'll see you next week. Take care.
Hey, this is Geoff Gannon, and that was the Focus Compounding Podcast, the podcast where Andrew and I talk general investing concepts. If you want to know more about specific stocks I like, go to focuscompounding.com, where you can read stock ideas written up by me and other members. Membership costs $60 a month, but if you use the promo code podcast, it'll be $50 a month for you. Andrew and I also manage accounts for investors. To learn more about our managed accounts, email Andrew at info@focuscompounding.com or text or call Andrew at 469-207-5844. That's 469-207-5844. Thanks for listening.